Gavin, hello.
Good morning, Nigel.
Morning. Right, well, we're just going to cover now the financial side of things, and perhaps you could start by giving us a little background about yourself and Blevins Franks.
Sure. So I'm the senior partner at Blevins Franks here in Portugal. I've been here for 20 years, Nigel, building the office and our client base here. We provide tax-led financial advice. So we're tax and wealth planners. Typically, our clients will be coming from the UK, and probably in line with the numbers that you got in your survey. So predominantly coming here to retire across Portugal, Silver Coast, Cascais, Algarve, and we'll give advice that ties the two systems together. So while people have been very used to saving in UK ISAs and funding their pensions, they're now maybe looking to draw down on that capital, and we'll lead them through the way to do that tax efficiently from a Portuguese perspective. And then importantly, thinking about having the right money in the right hands at the right time, and thinking about succession. So how do we make sure that our money passes to our heirs as tax efficiently, and also as simply as possible at that time, bearing in mind that people will often be dealing with two different jurisdictions, the Portuguese rules on the one side when they've moved here, and the home country, predominantly the UK, looking back at how those two regimes fit together.
Okay, so people moving to Portugal will have heard about possible tax benefits. Can you outline the non-habitual tax regime and how that works?
Sure. Well, 10 years ago, the Portuguese looked at their economy here, and like many countries, they have a shrinking population. And what they were looking to do was to encourage initially working people, what they termed high-value occupations. And they wanted these people to come and work in Portugal, and they offered a capped income tax rate of 20%. That was then expanded within the first year to cover people coming to retire as well. And this year we've had a change to that, which says that if you're drawing down foreign pension and you're receiving that in Portugal, then rather than it being entirely exempt as it was up until April of this year, you'll now have a fixed rate of 10% on that income. It's not an overly complicated system, but you do have to make sure that you've been through all of the detail around it to understand which forms of income and which form of gains will be exempt here in Portugal. But it runs for a 10-year period, so people coming to retire will know that they've got a fixed 10-year period whereby their pensions will be taxed at a maximum of 10%, and that other forms of income and gains may also be exempt.
Okay, and so who qualifies for this tax scheme, and how do they apply for it?
Well, if I start with your first question, who qualifies? Anybody who hasn't lived in Portugal in the previous 5 years, but has the right to come and live here, qualifies for the regime. So that's not complicated. And the second part, how do you apply for it? I think Edwina ran through the process of getting a tax number, getting your residencia, and then the final part of that will be you'll use your lawyer or accountant to make the application for the non-habitual residence tax overlay. So it's a straightforward application, and anybody who hasn't been tax resident in the previous 5 years can apply for it.
Okay, and so is it possible to be, a question here from somebody in the audience, is it possible to be tax resident in two countries, so Portugal and the UK at the same time, so spending, say, 6 months in each?
Yeah, that's an interesting question, Nigel. So technically, yes, it is possible. So if you think, again, Edwina was talking earlier about anybody spending more than 183 days in Portugal would automatically be deemed to be tax resident here. However, you may find that the statutory residence test in the UK, if you spent more than, say, 90 days in the UK, would deem you to be tax resident there. Fortunately, there's a double tax treaty that exists that then says, okay, the two tax authorities will have a look and determine through a series of tiebreakers exactly where which country has the primary claim to receive the tax. And then secondly, the double tax treaty will ensure that the same income or gain isn't taxed twice. So you'll only pay the highest rate that exists between the two countries. And yeah, an example of that might be that if you've already paid £100 of tax in the UK on a particular income, but you're tax resident in Portugal and the tax rate in Portugal was 110, you'd pay the additional 10 in Portugal, getting full credit for the 100 you've already paid in the UK. So the double tax treaty protects us in that way.
Okay, thank you. So when people are planning their move to Portugal, are there any other issues? Are there any issues from a sort of financial tax perspective they should think about before they make the move, or can they wait until they get here? And does Brexit affect your answer?
Yes, definitely Brexit affects the answer. But in any case, I would say that if you're aware and you're planning to make a move, then planning is the key word. Start the conversation early with your advisors to determine what steps you need to take and at which point in the process do you need to take them. So it may be, for example, if I give you the example of ISAs in the UK, individual savings accounts, which are tax-free in the UK, but not in Portugal. So it may be that you want to encash your ISAs in the UK because that would be a tax-free process in the UK, but it would be taxed if you'd already arrived in Portugal. So you want to look at the sequence of events and start that planning now. Brexit brings into focus the fact that from the 31st of December, the UK will no longer be in the transition period. They're already out of Europe, and in which case a number of things will no longer apply. So currently, anybody moving from the UK enjoys the free movement of goods, capital, people and services. And of course, it's our capital that we might want to look at and say, would there be tax consequences, in particular things like pension funds. If you want to move your pension out of the UK in its entirety and you wanted to move it to a scheme in Canada or New Zealand or Australia, currently you would pay an overseas transfer charge of 25% on that money moving. That transfer charge does not apply where the money is moving and the beneficiary is moving within the European Union. So again, if you're thinking about a move this time, before the end of this year or even into the early part of next year, you should already be having a conversation about your pensions, where they should be in the future. Should they remain in the UK? Should they be in a base where you can be thinking in euro terms? And again, that will be an important consideration, not just for pension, but for other assets, capital assets. Saying, should we be thinking about the denomination of our assets, of our savings? Because as we know, Nigel, I say over the last 20 years, I've seen the currency rates, and I know you'll talk about currency later on, but I've seen currency move from a pound buying €1.50 all the way down to parity. If you've got an amount of capital sitting in the UK, that exchange rate movement can decimate your wealth in those examples by a third. It can decimate your income by a third, it can decimate your capital by a third. So again, it's that kind of planning that you want to say, well, we think we can afford to live in Portugal with the assets that we have. What effects would currency have and what might come with Brexit?
Okay, thank you. We have a series of questions now that people have sent in before the webinar, so I'll just take those one at a time. The first one, do I have to spend the full 10 years of the non-habitual residence period in Portugal? What if I return to the UK before then?
Yeah, that's an interesting question. A lot of people ask me, Nigel, about that 10-year period, and they say, am I making a 10-year commitment? And the answer is no. It's just a tax overlay. So if you come to Portugal and you spend years 1 to 3 in Portugal, and then you move away for years 4 and 5, you can come back, but the clock has been ticking and you'll now do 6, 7 and 8 back in Portugal. So your movement is entirely unfettered. It's just that the tax overlay lasts for that 10-year period and it won't be extended if you move away and come back again.
Right, okay. The next one here is, my wife and I have individual savings accounts and personal pensions that they plan to use to fund their retirement. Will these retain their tax status when we're living in Portugal?
So let me break that down. You've got individual savings accounts was the first one, and pensions the second one. ISAs are tax efficient in the UK, but because they're not being taxed in the UK, they will be taxed in Portugal. So you want to think about the planning around those before you make the move. Pensions, on the other hand, they will continue to roll up in the pension structures themselves entirely free of tax. I'm assuming that these are personal pensions rather than company schemes. And then under the non-habitual residence rules, they will pay a flat rate of 10% tax as they're being drawn down, and that won't matter whether they remain in the UK or whether you move them overseas to Europe if they follow you to Portugal. But it just shows that there's different thinking to be had around. We can't just assume because you've got the non-habitual overlay that everything becomes tax-free. A number of things may be tax exempt, or they may be taxed at 10%, and other things you'll need to consider, like your ISAs.
Okay, thanks. So the next one, I understand from researching on the internet that Portugal has no inheritance tax. If I leave my estate to my children, will they inherit tax-free?
Yes, again, that's quite a technical question, because if you think in the UK we have common law, and in Portugal we have civil law that's grown out of Napoleonic Code. And the basic differences are that in the UK we have, after our death, we have an entity that we know as the estate, and that our estate has the same legal structure as an individual, as a company, and is treated in exactly the same way. That doesn't exist under civil law. Either you own the asset or you don't own the asset. So under civil law in Portugal, the asset passes immediately to the beneficiaries, and the beneficiaries pay a gifts tax rather than the estate being charged an inheritance tax. Assets passing from parents to children are exempt, so there's no gifts tax on that. So technically speaking, there's no inheritance tax in Portugal. However, the thing that British nationals will have to be careful of is that even having left the UK, if they continue to be deemed to be domiciled in the UK, they'll still be subject to UK inheritance tax. So again, how those things link together just needs a little bit of planning and thinking to say, how do we think in terms of succession in one column and tax in another column? So we say, well, it's okay, I can leave my assets to my chosen beneficiaries, but how will they be taxed? And again, that's one that we can help with, and that you should seek advice to make sure that you understand the effects from both your country of origin and now your country of residence.
Okay. So the next one, I have just sold my UK home and I'm about to rent a villa in Portugal with a view to buying a property on the Silver Coast. I have a number of different pension schemes, private, company and government, and my UK advisor recommends transferring them all into one SIP. Is that the best thing to do?
I would slow down and I would be careful. And the question I'd be asking my UK advisor is, what are the tax consequences of those moves, and how will the UK advisor intend to continue to provide advice once you've moved to Portugal? So I'd make sure that you're dealing with a firm that has that cross-border expertise. In terms of moving all your pensions into one SIP, that may be the starting point of a consideration, but if you're moving earlier, then you might want to think about where that SIP should be based. Is that a SIP in the UK, or is it the pensions equivalent overseas? So there's a bit of additional information to take that, again, I would just check and make sure that your UK advisor is up to speed on that, and that actually he has the licenses to be able to continue to advise you after the 1st of January. So there's quite a bit of thinking to be done around that one. You mentioned something else in there, Nigel, not just pensions. What was the other part of the question?
Well, it was private, company and government pensions, I think.
Yes, no, very important. So government pensions, if you think self-invested pensions and private company schemes, so I'm thinking British Rail, British Telecom, whoever these might be, the Gas Board, all of these private schemes will be taxed, due to be taxed in Portugal under the double taxation agreement. However, government schemes, UK government schemes, I'm thinking things like teachers' pensions, civil service, these kind of pensions will always be taxed in the UK. So again, it's a case of saying, well, how do we make sure in those cases that we're maximising our UK allowances, which we'll continue to have, and then how do we maximise the position from a Portuguese sense on your personal pensions and your ISAs and so on. So yes, a very important question. Government schemes will continue to be taxed in the UK at source.
Okay, and the next, this person plans to move to Portugal next year when their UK state pension starts, but all of their personal pensions, SIP, will be in sterling, and their expenditure will obviously be in euros. Is there anything they can do to eliminate the currency risk?
Yeah, there are a number of things that they might consider. So within UK schemes, you might consider how you could access euro denominated funds. Can you have a euro cash account within your pension, or do you need to move it overseas to be able to think about balancing these things off? If you've got UK annuities, government pensions, then these are always going to come as your state pension will in sterling. And so again, you'd need to be thinking about the currency position there and how you would be affected if the currency moved by so many percent in either direction, if it moves in your benefit or against. But really importantly, from a financial planning perspective, is how do you try to mitigate as much risk as you can? So if you're able to mitigate currency risk and balance and match your liabilities with your assets, then I would think that would be a great starting point for anybody.
Okay, thank you. And a topical one here. This person is from the UK, but has been living and working in Hong Kong for the last 7 years. Their aim is to retire to Portugal in the next 18 months. And they've several rental properties in the UK. They've also built up capital in a retirement fund provided by their employer in Hong Kong, which they can cash when they retire. What planning do they need to do or consider?
Okay, I think the first thing for any advisor is to hold their hand up and say, I cannot give any advice on the Hong Kong aspect of the planning that they're doing at the moment. However, we can talk about the Portuguese side. And so thinking about the opportunities that come along. George Osborne in 2015 introduced capital gains tax on UK property where people were selling from overseas. So regardless of whether our viewer is still resident in Hong Kong or they've moved to Portugal, in the past they would have had no capital gains tax on the sale of their properties. Today they've only got capital gains tax from the 6th of April 2015 till today. So any gain that has arisen during that period. From a Portuguese perspective, that gain would be exempt from tax in Portugal under the non-habitual residence regime because it could have been taxed in the UK, and in fact there may be some tax to pay. But if our viewer here has held these properties for some period of time and the gains were made prior to 2015, then there's a huge opportunity moving into retirement in particular to divest themselves of an illiquid asset, property, and to think about holding their assets in a more liquid and currency efficient form for their retirement in Portugal. So it opens up a big question to sit down and look at holding property in the UK. Are there advantages to be able even just to recapitalize and think about buying property again, but again recapitalizing and washing out the previous gain. The next one was capital, and there are a number of things that you can do with capital. There are a number of different platforms to use. There are tax wrappers that you can use for Portugal that will allow your assets to roll up entirely free of income and gains, and maybe you'll pay an element of tax as you draw down on those funds which would be in proportion to the gains that you've made. You might also use the non-habitual residence regime to ensure that your assets, if they're on a platform, that they're generating more income than gains, so gear your portfolios towards income. The income would be tax efficient under the non-habitual residence regime, but the gains wouldn't be. So again, making sure that your assets have got the right balance of income to gains. What is it that you're targeting for in the future, and how will you use these assets? It's a very personal conversation to sit down with people and understand how they're best going to get the most out of the assets that they've built up over the years. So from this individual living in Hong Kong, it will present a lot of opportunity around their pension planning, and their capital can be structured tax efficiently for a Portuguese perspective. It doesn't mean that things will be tax free, but it just means they'll be tax efficient in the same way as you would do UK planning using ISAs and pensions and other tax favoured schemes, national insurance savings.
Okay. So the next one is, my wife and I are selling the UK family home and buying an apartment in the Algarve. They'll be left with spare capital, which along with their pensions, they plan to live off. Will Portugal tax them on the capital when I bring it into the country, and how should they invest it in Portugal?
Okay, so very similar to the last question. There's no tax on capital. You're free to bring capital into the country. You can move it around the European Union if you decide to have a bank account or some other, using some other insurance institution or whatever in Luxembourg or Dublin or wherever. You can move your capital around and the Portuguese will not tax your capital. There are no exit taxes leaving the UK, and in this case you're talking about somebody selling their principal residence, their main home. So again, they would have no tax on it in the UK and no tax in Portugal. And they would use the same structure as our friend from Hong Kong. They'd sit down and have a conversation and would say, how are we going to use this capital now? How much of our pension do we need to supplement? Do we have to target for a particular element of income to cover your fixed costs? And then what are your discretionary costs? What sort of holidays do you want to go on from here? Although we quite often find that, and a lot of us working here in Portugal take our holidays in Portugal because it's a fantastic place to be.
Okay. Another one here. I've recently spoken with my UK financial advisor about my proposed move to Portugal, and she advised me to retain my ISAs as they are tax-free. She says the excess capital from my UK house sale should be invested into an Isle of Man offshore life insurance policy. Is all this correct and the best advice?
Sadly, no. As I mentioned earlier, ISAs in particular, we think, we've come from the UK and we say, oh, they're tax-free. Yes, they're tax-free in the UK, but they will be taxed when you come to Portugal, even under the non-habitual residence regime. And then this particular question is coming from somebody who the UK advisor has said that an offshore insurance bond is an offshore insurance bond, and therefore the Isle of Man is a good jurisdiction. The Isle of Man is a good jurisdiction, and if you were setting up an offshore insurance bond as a UK resident, I'd say it's perfect because the insurance company there is familiar with the UK tax rules, and they will prepare the correct paperwork in the form of a chargeable event certificate if you have a tax liability. The Isle of Man insurance companies, I'm not familiar with any that are able to provide a certificate that complies with the Portuguese rules, so you're more likely to want to find a provider either in Dublin or in Luxembourg, the two typical jurisdictions. So again, it's this idea that all things are equal, and I've got a little bit of understanding, be careful of a little bit of knowledge. You really need to speak to somebody who understands what's required from a Portuguese compliance perspective. You want to be certain that whatever you set up works from a Portuguese tax perspective, that it's acceptable in Portugal. One of the key things there would be to check that you've paid Portuguese premium tax when you set up such a vehicle. That would indicate that it's compliant within Portugal, and that the company themselves are able to provide a Portuguese tax certificate at the end of the day. You want simplicity. You want one piece of paper that says this is the tax consequence of holding this investment asset. You pass that to your accountant rather than, say, having to go through a portfolio and calculating all of the income and the gains element and having to make tax decisions or having your investment decisions guided by a tax consequence. So all of those things are fairly straightforward, but you do have to make sure you've got the right jurisdictions. And I would suggest that for Portugal, Isle of Man, Jersey, Guernsey are not geared up to do that, whereas the European destinations of Dublin and Luxembourg are. You would also want to consider the policyholder protection regimes that are there, because you can find yourself within the European Union in a far better regime than you might find in some of the UK dependent territories.
Okay, well, thanks for that. We've had a couple of questions in while you've been speaking. So this next one, referring to a comment made about actions to be made before moving. If I draw my 25% tax-free from my pension before I move and hold it in the UK in savings, is that tax-free? And if I draw the 25% after the move, is it taxable in Portugal despite being tax-free in the UK?
Okay, so from a pedantic perspective, the money that we take out, the lump sum that we take from our pension is called a pension commencement lump sum. And in the UK, if you take a pension commencement lump sum up to 25% of the fund, in the UK, that's tax-free. From a Portuguese perspective, this is just a lump sum you're taking from your pension. There's no tax-free element. However, if you have the non-habitual residence regime, then you'll pay a flat 10% even on that pension commencement lump sum. So again, that takes us back to one of the questions you asked me right at the beginning, Nigel, which is about the steps in the planning. So it may be if you need that money out of your pension, that you take the pension commencement lump sum before you leave the UK. However, it's not as simple as saying everybody should do that, because if you take that money out of your pension fund, the question now is you're taking it out of a very tax efficient vehicle. There's no tax on the rolled up income and gains. And you're taking that money and you're putting it into your own estate for inheritance tax purposes. It was inheritance tax free where it was, and you've now brought it into a taxed environment. So it's something that you might say, well, yes, on the face of it, that looks like a good idea, but you've got to think of all the knock-on effects for that. So it's a very individual thing. Sit down and have a chat with your financial advisor. What will your income requirements be? What will your capital requirements be in the short term? And how do you plan for that using your pension assets?
Okay, the next one, they have a SIP in partial drawdown, some cash still tax-free. Should they move it to Portugal?
There's no straightforward answer to that. Again, they need to take some advice on it and say, well, like the last question, do I draw down the rest of my pension commencement lump sum? Do I need the capital? And if you don't need the capital, then probably the answer would be leave it where it is and continue to draw down, because with flexible drawdown, you can draw down whatever you need. In the UK, it's more of an issue because you're thinking only the first 25% is tax-free. Thereafter, I'm paying tax on anything else that I draw. In Portugal, you're paying a flat 10% on everything. So you're able to say, actually, I can leave it in the pension fund and it will still most likely be more tax efficient when I come to draw it down in future years as a Portuguese tax resident than I would be had I been paying full rates of income tax in the UK. But that just needs to do that. You need to do the arithmetic, Nigel, for each individual and say, let me understand the tax consequence, but most importantly, what are my requirements? Do I need capital? If I don't, leave it in the tax vehicle. You might consider moving the SIP overseas to get the currency benefits, to lock in the flexibility that you have. One of the issues of leaving pension in the UK is political risk. So we've talked about currency risk, but what about political risk? If in the future, whichever government or colour of government happens to be in power, they do it continually. Every few years we have new rules around pension. So do you want to take your pension out of the UK and lock in the benefits that you currently have? So that would be another consideration, as well as what do I need in terms of income and capital from this asset.
Okay, well, thank you very much. Very clear. in a very complex area. So thank you very much, Gavin, and we'll now move on to some property issues. Okay, thank you.
Thank you, Nigel.
So then the next one is, if you become a Portugal tax resident in, say, November 2020, will it be taxable on worldwide income only from November, or for the full tax year, even if that's prior to taking up the residency? Gavin, can you take on?
For me, yes, both Portugal and the UK will consider a split tax year, but it'll be dependent on the nature of the gain or the income. So income, yes, generally it will be from that date. Gains may be treated slightly differently, so you just need to take specific advice on the nature of the gain, but you can have a split tax year in both.
Okay, thanks. The next one is again a financial one. If I move to Portugal, take up tax residence before the end of this year and sell a UK principal residence in 2021, will it be subject to UK capital gains? Or?
No, you've got a window both in Portugal and in the UK. Both tax authorities recognise that you may not sell on exactly the date that you want to sell or that you move, and so your principal residence, you do have some time to sell in the UK.
Right. Right. Again, Gavin is popular here. We have a house already in the Algarve. If we obtain residency before the end of the year, what are the capital gains tax implications for the sale of our UK residence, which is currently our principal residence? So that's a bit of a repeat.
I think, sorry, Nigel, I think is that the same question that?
It is. Having read it, it's the point you've just covered, isn't it? And this one was, who's the regulating authority for currency brokers? That's the SCA, is it not, Robin?
Yes, that's correct. All of the advisors at Blevins Franks are fully UK qualified, so they'll hold all of the UK qualifications. This year, there's no FCA register of individuals, but you would have seen all of the individuals on the register up to that point. And the FCA is about to produce a new register of individuals. But Blevins Franks as a company, our group office, the overriding regulatory authority is the Financial Conduct Authority in the UK. And they're then further registered and regulated in the countries that we operate in: Spain, France, Portugal, Malta. Yeah.